Welcome to the Commercial Real Estate Report. Today we're talking about where is commercial real estate headed? Obviously, dynamics changing. I'm sure you've seen the news. WeWork, once a $47 billion company, now files BK. Also, our guest today, big fan of Warren Buffett, Berkshire Hathaway, sitting on a record amount of cash, $157 billion. We're talking about how he interprets that and much, much more. I'm your host, Chris Berg, head of business development here for Abernathey Holdings in California. We build Class A self-storage sites. Joining us today, Chairman and CEO of Abernathey Holdings, Andrew Abernathey. Andrew, it's great to see you. Welcome back to the show, man.
Hey, appreciate you having me on. I'm really excited.
So I set it up, I think, fairly well here with WeWork filing, $47 billion to BK. Warren Buffett loves cash. When there's blood in the streets, sitting on records amounts of cash. I guess, number one, how do you interpret that in the light of commercial real estate? And then what, as you look over the horizon, what's keeping you up at night these days?
Yeah. So, Warren Buffett, if you look at the market cap of Berkshire Hathaway, he's sitting on about 15 to 20% roughly in cash, right? Because that fluctuates. And that historically, that's pretty average. It does get lower. I mean, anybody would much rather put that cash in an operating company or an investment, but he only does investments when they make sense. And money's like oxygen, right? Like when you have it, you don't think about it. And when you don't have it, that's all you think about. So he has always made a point to always have some cash on hand. So, but if you look back in history, his cash pile has increased as a percentage to valuation, usually towards the end when there's a correction, and then he gets to go and deploy it. And I think before we can talk about the future, I think it's always good to talk about the past, right? I think history rhymes. It doesn't always repeat itself, but it for sure rhymes. I'm a believer. I am a nerd, and you know this, Chris. And I think one of my strengths is analyzing things, and one of my weaknesses is maybe overanalyzing things sometimes. But I think net it's still positive. So I'm going to try to summarize this and not go down too deep of a path. But I've done a lot of research all the way back to like the Habsburgs. This was back in like the 1400s, right? And they ruled the world, right? And then the Dutch, they took over, and they were the reserve currency, and they went through the whole cycle. There's usually 6 stages, and then after stage 6, you start over. And the British then took over after the Dutch, and then we took over, officially in about 1945 is when we took the reserve currency over. And reserve currency is a huge power. The problem, though, is it's literally the license to print money, especially when you separate it. You have fiat, non-fiat currency, right? When you separate it from a hard gold, for example, or silver, like back in the day. So the gold standard happened. They separated it. You have a license to print. Everybody wants to save in it. It's a reserve currency. And this has happened the Dutch. It's happened the Britons. What happens is you eventually become the wealthy country, comes into the point where labor and time is very expensive. So it's easy for a different country to compete, right? That's where globalization happens, and China can build products less than we can, and so forth. That happened in the Dutch. The Dutch invented the stock market, basically, and they had the shipping company that went bankrupt. I think Isaac Newton leveraged his house and lost it all in the stock frenzy.
Yes.
And what happened is British just took the idea. They had cheaper labor, and then all of a sudden they became the power. And again, this happens over history. And so another thing that happens is an empire becomes so big, it's no longer profitable because you spend so much defending yourself, right? So really it becomes unprofitable. So stage 3 in the 6 is usually the most prosperous, the best time. So after the World War II in 1945, usually after those big wars, comes a time of peace and prosperity. Everybody in the world knows who won the war. It's a good time. But then comes when the money starts to get printed, then the debt starts coming. You have the 7-year debt cycles, and then within that, you have the long-term debt cycle. We're kind of at the beginning of the end of the long-term debt cycle. Back in 1930, 1929, right, the Great Depression, interest rates went down to basically zero also, through the 30s mostly. And same thing after 08. 08 is kind of a similar bubble with 1930s. And so What happens is when the government gets in so much debt, there's only so long the Federal Reserve can print money. They build their balance sheet. They buy the bonds themselves to try to keep the volume in bond purchasing high so they can keep the interest rates low artificially, right? So there's 3 stages there. Well, when you get to the end of the cycle, it works until it doesn't, right? And that's kind of where we're at or going to be. And again, I don't know if this is a week or 10 years or whatever it is, but what you're going to have, I think, and nobody knows, the question is, where do you want to place your chips? Where I'm placing my chips is that what's inflationary and what's deflationary? Inflationary, deglobalization. That's inflationary. Okay. And we're seeing it already. What else is inflationary? Printing money. Right? When you print money, inflationary, right? What else is inflationary? Deficits. Right now we're at a 5 to 10% deficit, the government. And that means they have to sell bonds, which they just did a bunch of, to fill the hole. Well, if you have a lot of bonds going on the market and people are getting a little less like, are they going to be able to pay this back, right? They got to offer a higher interest rate to get buyers. Other thing that's inflationary is, agree or not agree, the world is spending a lot of money on going to green, clean energy. Right now, the world is $100 trillion in GDP combined, and they're projecting a $5 to $10 trillion annual cost for this. So there's another 5 to 10% deficit, inflationary. So I can go on forever. Deflationary would be like AI, right? If you can increase the product output per hour unit invested, that's deflationary. So that helps. But if I were to guess, I would guess the 10-year bond is going to average 4.5 to 6% going forward, which in the past, when the bond yield got really low, the spread got pretty high there, 4+ for the cap rates. I think that'll compress. I see cap rates 6.5-ish, maybe 7, depending on if it's a prime A or class, whatever site. In Arizona, maybe a 7-ish. California, some areas might be 6.5. If you go back in history to 1982 and you look at the general cap rate for real estate, Class A, it is at 7.62%. 33% of the time it's below it, and 67% of the time it's above it. Every time it dropped below the average, it was usually on average for 3.3 years, and there was always a balloon after. 91, 08, just happened now, every time. So if I were to place my chips, I would say that we should have, if we're developers, I think self-storage deserves a lower cap rate than the average just because of the security of the business and the simplicity of it. So I'd say let's bet on a 6.5, 7% cap rate depending on the site. And if you're a developer, you're probably going to need a little spread there, of course, for your risk time and everything. So a 9% yield on cost plus, I think is probably the new normal. And I think the reality and it happening, there can be a gap sometimes. And that's what we're kind of waiting on, is some sellers are ready to do that and some are not ready yet. So.
Boy, that was so much. I've got so much.
Yeah, sorry, I really went there.
No, and I love it because if we could go down and you kind of pick what alley you want to go down here, but like we could go down the Bretton Woods path, right? We talked about 1945. We can go into when Richard Nixon stands in front of the nation and says, "Oh, this is just going to be temporary. We're going." And I don't know if you've ever seen the website WTF happened in 1971, which is when Nixon took us off. But that website shows, you talked about productivity, how you've had this huge wealth gap now because of everything going on. Or we just go into back. So as you laid out this historical patterns and you look into the future, what's keeping you up at night? So if you want to go down all three of those, just one of them.
Let's do it. Let's hit them. I'll just kind of start. So yeah, if you look at the interesting things, let's just look at the 70s. Interesting time, right? In the 80s, the cap rate was below the interest rate. It was inverted, right? And what led to the bust in 91 was when inflation was taking off, everybody actually eventually flocked to real estate because it was one of the most inflationary proof things that there was. Because if you look at the stock market through the 70s, it has 0% return, inflation adjusted. 0% for 10 years, inflation adjusted. And that's rough.
Through the what?
I think it's through the 70s there when inflation was taking off, it was a 0% inflation adjusted, right? So you have the real and the nominal. And that's where people, and I'm young, right? I am reading all of this from literature. I've been an investor since 2009 after the crash. Fortunate, I've lived in a very low interest rate environment. we don't even understand when I talk to someone and say, what's your return? They don't even think about saying real or nominal, like inflation adjusted, basically. They've never had it. So would you rather have an 18% return with 15% inflation or a 7% return with 3% inflation? I'd pick the latter.
Exactly.
It's all about the spread. So people back in the day are like, yeah, I'm making 20% a year in 1980s. Like, yeah, inflation was 18%. You made 2%.
Yeah. And then you start to put in the risk tolerance of people, right? And you talked about bonds recently. I mean, short-term T-bills right now are kicking out, 5.51, 5.2, and there's kind of this moniker going around right now where buy T-bills and chill, right? I mean,
because if you're doing if these people right now, they're saying like, hey, I still want a 7% yield to cost, easy math. Okay, my IRR, assuming cap rates are coming up 7%, maybe less. What's the point? I can get 5.5% in a cash account. Now, right or wrong, at the end of the day, if you're underwriting stuff at 8.5% or less, you are literally putting your chips on things will go back to historically weird lows of interest rates and cap rates. You're putting the chips on that. Now, the other side of it, though, too, is inflation. If you're thinking inflation is going to raise cap rates and keep interest rates higher, it's also fair that you need to raise rental rates faster, too, though. I still think so. Yes, I think we need to underwrite things at a 9 to 10% yield to cost, but I also think it's only fair that we are more bullish on rental rates.
Well, I think you bring up a really good point. I talked to a gentleman last week who's done $7 billion in self-storage. We were talking about, this asset class. It's not recession-proof, but it's one of the better asset classes during a recession. He says, Chris, the interesting thing about storage that people don't often talk about is that right now we're in this weird place where rates are so low for mortgages, nobody's really moving. So he said, hey, if rates go down, you're going to see people start to refi and move again, which is good for storage. But if rates continue to go up, you're going to see a higher unemployment, which is going to cause people to move, which is good for self-storage. What say you?
Yeah, I do agree with that. And the question, though, is how will interest rates react? Now, again, kind of going back to the 10-year bond, right? Because that's kind of helps drive interest rates. And the stock market thinks that they're going to cut rates early next year, call it mid next year. Okay. The 10-year bond, just understanding the rate there. Why does the interest rate go up? Is because the demand for them is low, right? Or high, excuse me. So it's vice versa, or low. So it's high, vice versa, excuse me.
Yes.
And so what I'm watching is, okay, if the world is uncertain right now, well, everybody, when there's a war, they flood into the reserve currency, and that lowers their interest rate on it, right? So there's all that demand that floods in. Also, with recession potentially happening, everybody floods in as well. So if interest rates get cut next year by the Fed, I think that means that the economy cracked and it dropped, like maybe in a recession. If the economy's not cracking, inflation's sticky, trust me. Why would they lower interest rates that fast? So do I agree with you? Yes. Do I think interest rates will go back to where they were? No. If or when the Fed drops interest rates, it's probably going to be because the economy's cracking, because first it's inflation, then it's interest rates, then it's the economy. It's always lagged. And on average, it's 6 months lagged. But with all the cash that's been thrown in the system, like we've talked about, it's kind of prolonged this. If it wasn't for all the helicopter cash, because during the war in 1945 and then also World War I, they printed a lot of money, right? The deficit to GDP for World War I was like 30-some%. It was like 27% for World War II, and it was like 17 or 16% for COVID. The difference, though, is in the wars, they printed money and it was sent into a war. This money was really helicoptered over the economy into people's pockets. But you're seeing subprime auto delinquencies skyrocket. You're seeing savings of Americans go from the highest it's ever been to dang near the lowest already. And there's just a lot of signs that I don't know. I'm not betting on a hard or soft landing. I'm just trying to make our deals make sense. But, I'm not betting on things going back to the way they were when it comes to interest rates. I don't think I can make that bet.
No, I agree. And again, nobody really knows, right? And we'll see. But you've got a lot of great points. Sam Zell's talked about before he passed. One of the main things he was focused on is, hey, what are we going to do to preserve ourselves as being the world currency? And I want to have more just maybe micro, if you don't mind, and just what you're seeing right now as far as self-storage in the Phoenix area. I know recently we saw some reports where rates have been going down. You had a meeting this morning where at one point, maybe 15, 18 months ago, you guys had put out an LOI at around 9.5 million. Today, the number is much lower. Like, walk us through what's going on there.
Yeah, so we've had deals now so we've had deals that we've closed on, right? So we've got about $110 million in projects that are, 7.3, 7.5% blended yield on cost. Now, is what it is. We're going to do those projects, maybe spread them out a little bit to kind of have inflation and rental rates, which could raise in construction too, but they're great sites. We're fine long-term, but any site that we hadn't closed on that we had at a 7.5%, 8% yield to cost, we tried to renegotiate. If they didn't, we canceled. So we canceled over $100 million in projects the last couple of weeks. We've got another about $400 million to deploy over the next few years, whenever the deals are right. I don't want to put a time frame on it, right? But ready to deploy. And then once that's deployed, refinance it and stuff, and we'll just keep rolling from there. So let's just say we've deployed about, easy math, 20% of our capital. We got 80% left to deploy. I consider that very lucky. But yes, there's deals that we underwrote 18 months ago at $9.5 million for dirt. Now, this is California and a bigger site, great site. We went to re-underwrite it, or we first backed out because we're just like, hey, we're just getting into California, and it's just good. Looking back now, it's a good thing because they reached out and were like, hey, we'd like to start conversations again. That's a good sign. So yeah, we had a meeting this morning, and the site, we re-underwrote it, and rental rates went from 230. They're down to 205 blended 12 month. They're actually at 198 today. Okay. And construction costs are a little bit higher, not crazy, a little bit. Okay. Well, now if we need a 9% yield to cost, we're looking at if it's 210, right? You're 2.25 million. If it's 230, if you think rental rates will go back to where they were, which I'm bullish, right? If inflation's going to keep rates higher, it's got to keep rental rates higher too. So let's just say I'm bullish and it's going to get to 230. You're at 4.5. Okay. So I think, yeah, it's a big difference. And so I'd make a bet on that. I think, again, we're still kind of going through it. I try to be smart, not too emotional, but sometimes you get excited. But yeah, we were at 9.5. They came down already to 5.5 before I even threw a thing out. So, we're at $1 million spread between our top and apparently their bottom, and we'll walk if needed. That's so what I'm taking from this is this. A week or two ago when we redid our underwriting, which Chris, about, I said, it could be 6 to 8 months before reality hits and there's deals to underwrite. Potentially. Nobody knows. I think, because again, we've already got $110 million in deals we're going to go on. So we've got plenty of work. Because your land team's done such a good job. You guys can take a hiatus here. But I think that reality is hitting people now. It could take, because she might come back and say, okay, 5.5 is not, that's all we can do. So maybe it is a few more months, but I don't know the answer yet. I'm curious when reality will hit, and this will be this. They were here, we were here, and now we're here. Is this a 6-month thing, or is this I don't know. Excited to find out.
And I want to talk more about that. Thank you guys for people that are watching, making some comments. But Henry, yeah, great insights here from Andrew. And there's more to come. He's going to continue to be a guest here. And I just want to re-presence this for a moment for people can appreciate. We're talking it was August of the prior year, so 2022, where we sent out an LOI for 9.5, and just 15 months later, essentially, maybe 16, they're coming back to us saying, hey, we'll take 5, right? I mean, it's a huge gap. So I want people to be present to what's happening here in Cali, but also there's recently a deal, if you don't mind sharing, and I don't want to give away any locations, but we had a deal that we were going to pay a top dollar on a piece of dirt. And then all of a sudden we came back and we're like, hey, we can pay you this. So walk us through that example as well, so people can start to appreciate, because I think what I'm trying to get at is I think sellers are beginning to come back to earth.
Yes. Yeah. Cause that's kind of where it is. You're hearing a lot more of, hey, we're motivated, right? Motivated sellers, or, we're all into it for this. We're just trying. That's the conversations I'm having. Now, they're not saying like, hey, I just don't want to lose much. It's still at the point where this is what I have into it. I really still want to make a little bit. That conversation, I think, will get there. And here's the other thing is, I don't want to get too off path here, but What might happen, and this is interesting, because if inflation does go up, what'll happen is you're going to have cap rates go up, and you're going to have a nice few years here potentially of having or being able to underwrite deals at a fair price. Okay, you have a few years, but if inflation does stay higher, you're going to have this, I think, potentially have the 70s again, where you're going to have so much competition again because everybody wants to buy real estate. Everybody's expecting construction costs to go up faster. Everybody's expecting land prices to go up higher. And then all of a sudden you could be built up and you could have, but again, this goes back to our, on an average of 10 years, 33% of it is euphoria. So that's interesting. So it could go back to that. But yeah, I think over the next few years here, people are going to have to come back to reality. And if somebody wants to hold out and see if euphoria comes again, that can happen. But you have a lot of people that want to get the cash off the table. Maybe they got a mortgage. Maybe they got investors. There's just so many reasons. So yeah, that's kind of where I'm seeing it as we have this into it. We just really want to make a little bit.
So can you walk us through, and again, if you want to get into specifics, I'll leave this up to you, but what just recently happened with a great site in Arizona and where we were at?
Oh, the Arizona one. Okay. Got it. Yeah, I was still talking about it. Yeah, so the Arizona one was the same thing. So we had one there. We were supposed to close November 1st. We were excited. It was our first 2 stories down. So it's $4.5 million, and it was, the rental rates were like 218, and they dropped to 150. Now that was a big drop.
From when? 218 to 150, and how long?
12 months. Call it.
Wow.
Okay, so that was tough, and I'm bullish on rental rates because, one, there's a supply demand. I think people are going to be a lot less construction in the next few years, which is going to have a lot of pressure on rental rates in 27 on, 28 on. Plus, if there's escalated inflation, I'm very bullish. A 9% increase in rental rates in a few years would be similar to a 5 or 6% pre-inflation. So you always got to keep that math. But you also have to increase expenses. I see some people that increase rental rates, but leave expenses at 2%. But anyways, back to this. So yeah, it's 2 stories down. First one that we were going down on, we got the construction numbers back, and I live and learn, right? They were a lot more than we thought. And they were a lot more than the seller thought too. So, and the interest rates were coming up. World's crazy, right? So we went back to them. It's like, hey, construction costs were like 30% more. Okay, big difference. First, like, hey, I mean, we're $1.5 million. And that is still only like a 7.8, 7.9% yield on cost. I was just trying to like say, like, hey, we're in contract. I want to honor. I want to do right by this. So we're willing to take a haircut, meet in the middle, right? It's not the 9 we need. It's not the 7. It's meet at like 8. And I told our team, like, hey, we might have to sit on this for a year. Just let rental rates come back a bit, so we're not opening it up and they wouldn't do it. The lowest they would come is like 2.7. But they came down to 2.7 from 4.5.
That's what I was going to get at. I mean, it was at 4.5. We were ready to go. All of a sudden say, hey, this doesn't work except for at 1.5. And they went down. I mean, and if people knew the location, I don't want to give that away unless you do, but if you knew, it's a phenomenal piece of dirt.
Mm-hmm.
All right. As always, we want to try to keep this thing within a certain time frame.
Yeah.
So anything else you want to add or share that I'm not asking you?
I mean, like I said, I'm a history buff, so I could just, and that goes back to one of my weaknesses is overanalyzing. But I think I'm an investor, not a gambler, and it's all about, if I think there's a 60 or 70% likelihood of something, that's where I'm going to set our chips. And I also look at it as a CEO is, okay, if I've got 2 roads, what's best case and worst case for both roads? Well, I went down the one side. It's like, hey, we got $110 million in projects. Let's just redo our underwriting. And if we find 9% yield to cost, we'll continue and do more. Okay. That road, best case, we're right. The economy corrects, and good thing we caught ourselves. Worst case, I'm wrong. Everything goes back to normal and we just start up again. No big deal. So it's not that bad a deal. The other road is, let's keep underwriting stuff at 6-7% yield to cost. And let's say I'm right and the economy does correct. We can't refi anything. We're underwater or can't refi. Well, now what? So now the only way to keep building is raising more money, because you're going to sell at a break even in 5 years. You can't refi. So that's worst case. And that's a lot worse than the worst case of option 1. So there's no foolproof to any of this, but that's how I looked at it.
No, but I like what you're saying. Let me see if I'm interpreting this right. Hey, Chris, we've got a very disciplined approach right now. We've got the yield to cost at 9%. We've got an IRR number. So essentially, if those deals that we see, we underwrite them and they work, we'll continue to make those investments. In other words, dollar cost average in is maybe one way to look at this over the course of time. Because as you say, if there's going to be a squeeze on supply, if we can keep DCAing into the system, if you will, 10 years from now, 2033, we're all going to wake up and be giving each other high fives. Yes.
Correct. Especially if inflation does stay elevated, you're going to have, once all this is done and it's going to get more and more every year, I think the next euphoria isn't going to be because of low interest rates. I think the next euphoria market's going to be based on people flooding in because of inflation hedging. Two different euphorias, but both create bubbles. And I would like to be a large owner. We all would at that point. And then hopefully we make the right moves at that point and not get sucked into it ourselves. But that's a future us problem. But no, I am all for it. It's going to be a good market here the next few years, I think. Once reality hits people.
Henry, thanks for the comments here. One more I want to share from him. We're seeing that seller expectations are resetting in retail already, but reality is the best options won't reset much. The other 90% of projects should fully reset inside the next 6. And we feel the same way. I mean, do you concur with what he's saying here?
Yeah, no, I do. And again, no guarantees, but that's where I'm putting my chips. I just think based on history, I think that's a safe bet.
Yes. Again, Andrew Abernathey, Chairman, CEO of Abernathey Holdings. We build Class A self-storage sites, predominantly focused in California and Arizona. We may be expanding that footprint, but no promises.
Deals are deals. Send them over.
See a couple things on the horizon.
Yeah.
As always, thank you for the time and the insight, man. I really appreciate it.
Thank you.